Most people who buy Bitcoin do it the wrong way. Not wrong as in illegal. Wrong as in they buy once, watch the price drop, panic, and either sell at a loss or never buy again. There is a simpler approach that removes that entire problem. It's called dollar cost averaging. And once you understand it, it's hard to think about buying Bitcoin any other way. I'm Sats, and today we're making dollar cost averaging actually make sense. Let's keep it simple. Let's start with the problem it solves, because the strategy only makes sense once you feel the problem. Timing the market is hard. Actually, let me be more direct than that. For the vast majority of people, timing the market consistently is impossible. Even professional fund managers with teams of analysts and access to real-time data get it wrong more often than you'd expect. The idea that a beginner sitting at home can reliably buy Bitcoin at the bottom and sell at the top is not realistic. And chasing that idea is what causes most of the pain. Here's what actually happens when most beginners try to time it. Bitcoin has been in the news, they've been watching it climb, they decide to buy, they put in a lump sum, then the price drops, maybe significantly. Suddenly that decision feels terrible. They either sell at a loss to stop the bleeding, or they hold on but feel anxious every time they check the price. Neither outcome is enjoyable, and neither is the experience that builds long-term conviction. Dollar cost averaging is the alternative, and the idea is almost embarrassingly simple. Instead of putting all your money in at once, you invest a fixed amount at regular intervals. Same amount, same day each week or each month, regardless of what the price is doing. If the price is high, your fixed amount buys you less Bitcoin. If the price is low, your fixed amount buys you more. Over time, your average purchase price smooths out. You automatically buy more when it's cheap and less when it's expensive, without ever having to predict which is which. Now, here's the thing that makes this more powerful than it sounds on paper. It removes the emotional decision from the equation entirely. You're not watching charts and deciding when to buy. You're not reading news headlines and second-guessing yourself. You set the amount, you set the schedule, and it runs. The price going up or down stops feeling like a problem to solve and starts feeling like background noise. I'll be honest about my own experience here. Before I started doing this, every time the price dropped, I felt like I needed to do something. React, adjust, buy more or sell some. That constant decision-making was exhausting, and it led to worse outcomes than just doing nothing would have. The moment I switched to a fixed regular amount, the psychological noise almost disappeared. The price can do whatever it wants. My plan doesn't change. Let's talk about what this actually looks like in practice. Say you decide to invest $50 a week into Bitcoin. Week 1, Bitcoin is at $60,000. Your $50 buys you roughly 0.00083 Bitcoin. Week 2, Bitcoin drops to $50,000. Your $50 now buys you 0.001 Bitcoin. Week 3, it recovers to $55,000. Your $50 buys 0.00091 Bitcoin. After 3 weeks, you've invested $150. And because you bought more when the price was lower, your average cost per Bitcoin is lower than the average of those 3 prices. That's the mathematical edge that dollar cost averaging gives you over a fixed price purchase. Now here's an important thing to be honest about. Dollar cost averaging is not a guarantee of profit. If Bitcoin's price falls and stays down for a long period, you will be buying regularly into a declining asset. The strategy reduces the risk of buying at a single bad moment, but it does not eliminate market risk entirely. That is worth being clear about. What it does do is make investing into a volatile asset more manageable. It prevents the worst outcome for most beginners, which is buying once at a high point, panicking when the price drops, and selling at a loss. And it keeps you consistently building your position over time rather than waiting for the perfect moment that never quite arrives. How do you actually set this up? Most major exchanges make this straightforward. On Coinbase, you can set up a recurring purchase directly from your bank account. Choose the amount, choose the frequency, and it runs automatically. River Bitcoin in the US has been specifically built around the DCA philosophy and offers very competitive fees for regular buyers. Strike also lets you automate regular purchases easily. The frequency is up to you. Weekly tends to smooth things out more than monthly because you're averaging across more price points. But monthly works perfectly well, especially if you're aligning it with a paycheck. The amount matters less than the consistency. $20 a week beats $200 whenever you remember to do it. One practical note on fees. When you're buying small amounts regularly, fees can eat into your returns more than you might expect. Check the fee structure on whichever platform you use. River and Strike tend to be competitive for regular small purchases. Coinbase's fee structure is worth checking before you set things up. Here's the thing worth sitting with before we wrap up. Dollar cost averaging works best as a long-term strategy. Not weeks, not months, years. The reason it works is that it captures the long-term trend, rather than trying to pick individual moments within it. If you believe Bitcoin has a higher value in 5 years than it does today, then buying a little consistently over that period puts that belief into practice in the most disciplined and low-stress way available. It's not exciting. It doesn't make a great story. You don't get to tell someone you bought at the exact bottom, but it works. And more importantly, it's something a real person can actually stick to. All right, let's make sure this lands clearly. Dollar cost averaging means investing a fixed amount at regular intervals regardless of the price. Same amount, same schedule, every week or every month. When the price is high, you buy less Bitcoin. When the price is low, you buy more. Over time, your average purchase price smooths out and you remove the need to time the market. The psychological benefit is as real as the mathematical one. You stop making emotional decisions and start following a plan. It does not eliminate risk. Bitcoin can fall and stay down, but it reduces the worst beginner mistake of buying once at a high point and panic selling when the price drops. Set it up on Coinbase, River, or Strike. Choose your amount, choose your frequency, then let it run. Consistency over time beats perfect timing every time. If you are still buying Bitcoin on an exchange and leaving it there rather than moving it to your own wallet, that is the next thing to fix. The video on what happened when I left my Bitcoin on an exchange explains exactly why it matters and what to do about it. Watch that next. Stack smart, stay curious. See you in the next stack.